Today, I'd like to talk about trading energy, specifically crude oil, comfortably, and notice that word's in quotation marks, with any account size. My name is Carley Garner. I'm a futures and options broker. We run a boutique brokerage shop in Las Vegas, Nevada called DeCarly Trading. If you have any questions, comments, concerns about anything we talk about today, or you want to just learn more about the services we provide, or even just about trading commodities in general, visit DeCarlyTrading.com. There's a lot of educational material. It's free to access. We're big believers in education because an educated client is a better client. And again, we are a brokerage service. We offer everything from full service to discount online, and we'd love to have you. If you're on social media, you can check us on Twitter, Facebook, and Instagram. Just search for DeCarly Trading or Carley Garner, and it should pop up. If you are not a dog lover, stay away from my Instagram page. In fact, actually, probably all of my social media is going to be littered with pictures of my dog, Frankie. This is her sitting in front of the Las Vegas sign. If you're not familiar with who I am and what I do, I am a broker and an author. I write a column for Stocks and Commodities magazine. I provide content to Jim Cramer's Mad Money a couple times a month, maybe once a month. Bloomberg Television, I visit a couple times a month as well to talk about option trading. And if you're a client of ours, we do send out a couple of in-house newsletters, the Financial Futures Report and the DeCarly Perspective. We basically put out our market projections in commodities as well as the financial futures. We provide specific trading ideas and strategies, catering to different account sizes. Whether somebody's trading $2,000 or several $1,000,000, we'll give you some ideas. Of course, we don't have a crystal ball and we're not perfect. The idea is hopefully we can provide a perspective that maybe you haven't seen before in regards to strategy and timing and things like that. If you're interested in learning more, I've written several books, but these are the only three you need to really pay attention to. These are the newest. The most recent is Trading Commodity Options with Creativity. You will find other books listed on various websites and bookstores. Don't worry about those. They are outdated. They're a previous publisher, and to be honest, they're only trading on the secondary market, and so they're overpriced. So stay away from those. These are the only three you need to worry about. And I want to make sure everyone understands that there's a substantial risk of loss in trading futures and options. It's not suitable for everybody. It's extremely risky. It's not investing. It is speculating. There's no dividends or interest, and you're not guaranteed to make money even if you hold on forever. Commodities are a much different animal. Oil is obviously a very hot topic as of late for various reasons. One being that politicians around the globe have basically weaponized energy. Crude oil plays a very large role in our daily lives, and whether we really know it or not, we're actually speculating in crude oil all the time through purchases of fuel, through purchases of products that include plastics. And the relationship between crude oil and consumers has stayed relatively constant. As consumers, we want oil to be lower because then our goods and services are lower priced. But when it comes to how oil and the stock market react one another, it gets hairy. Reality is, everybody that starts to trade commodities wants to trade crude oil, and for good reason. But the problem is, it's a really volatile market and it's difficult for beginning traders to manage. We're going to show you today a couple of ways via strategy as well as via just using smaller products to get involved in oil without taking outsized risks. What is fundamental analysis? Fundamental analysis is the study of interaction between supply and demand to be used to predict future price movement. Ultimately, the concept of fundamental analysis is built upon the following equations. If demand is greater than supply, commodity prices go up. If supply is greater than demand, commodity prices go lower. It sounds extremely simple. This is a very simple equation, but unfortunately it doesn't work that way because markets and market prices are driven by humans who are emotional and sometimes irrational. There are a lot of things that are interfering with these very simple equations. Another thing is garbage in and garbage out. These equations require that we have quantifiable, accurate, and real-time statistics, and that just isn't always possible. In crude oil, we have relatively current stats. We're looking at numbers weekly, inventory reports, and we have two major outlets that report those numbers. But even so, there's a lot of questions as to the accuracy and the timing, so on and so forth. If we're talking about fundamentals, simple formulas become confusing at best and misleading at worst. Because of this, I believe traders should combine fundamental analysis with chart work, seasonal patterns, and the COT report, which is the commitment of traders. It's issued by the CFTC, and it's basically a report that tells us who's long and who's short and by how much. I also like to look at market sentiment readings to see if a trend is overheated or just budding. In my view, trading solely on fundamentals requires deeper pockets and steadier nerves than most traders have. And so it's a good idea to just keep your mind open and look at some of the other things. Also, people tend to fall in love with the narrative. If all they hear or read about is a particular storyline in the commodity markets, it's hard for them to think that anything else can happen. For example, when oil was trading at $120 a barrel a couple of weeks ago, nobody expected it to drop to the low 90s. And guess what? It did. Because those types of things happen when everybody's bullish and everybody's probably already long the market that wants to be. The market simply runs out of buyers. And also, markets are forward looking. So the fundamental story that's going on today doesn't necessarily mean that that has anything to do with what's going to be going on in the future. The markets tend to make their move before the fundamentals change. So it's really tricky. Anybody that's been following the oil market knows that the market has taught us this lesson over and over. For example, in July of 2008, the world was convinced we were running out of oil. There were numerous headlines and stories and newscasts about peak oil, and the idea was this is the beginning of the end for the fossil fuels. We needed to find some other route to get our energy, and we were running out of time. Well, that was July 2008, and coincidentally, my mother purchased a Prius right around that same month because she told me oil prices and crude oil prices, or specifically gas prices, were never going to go down again because of this oil shortage. Literally weeks later, oil rolled over and dropped to $30 a barrel. So I'll let you know if my mother decides to put solar panels on her roof, or maybe it'll be a good time to be bearish energy at that point. Anyway, the point is, just when everybody was the most bullish you could possibly be in oil, things changed quickly. I remember at the time when we were trading at $150 oil or $140, there were projections for $200 oil, $250 oil, and nobody doubted them, and everybody just accepted them. Nobody thought anything else could possibly happen. Similarly, a few months later, when oil was in the 30s, it was during the financial crisis. The world was seemingly coming to an end. It was pretty depressing out there, and everybody assumed oil would stay lower for longer. There just wasn't enough demand to push oil back up to the areas that it was trading at before the financial crisis, but that turned out to be inaccurate as well. In 2014-15, we had a massive supply glut because of fracking. Fracking became very popular from 2012 to 2014 and literally broke the back of the oil market. I remember at the time a very famous oil analyst stated that we would never see, well, actually, that's not what he said. He said, we won't see crude above 44 again in my lifetime. That was with oil trading at 30. Market went above 44 probably 3 or 4 months later, so that didn't work out as planned. But the reality is, at that time, the whole world assumed that oil was going to stay lower for longer. It wasn't just him. And then, of course, in 2020, more recently, we had the COVID shutdown, OPEC's price war, all at the same time that ultimately pushed crude oil down towards $10 a barrel. Some of the front months even traded lower than that. The front month traded negative. That was a little bit of a fluke or fake news, but people like to talk about it. That said, when oil was trading under $20, very few people could have seen $130 oil coming within a year and a half, 2 years. That's exactly what happened. My best guess is with oil up well above 100 for much of this year or much of the last couple of months, we're probably seeing some sort of long-term top just like we've seen in the past. But it's hard to imagine that because how many crude oil bears do you know? Probably not very many. Everybody thinks oil is going to continue higher. That's generally when things do the opposite of what we expect. One thing I'd like to point out while I've got this chart though, and it's kind of off topic, you can see that in July of 2008, we had a little bit of a pattern. It actually started much sooner. But you can see crude oil kind of held this uptrend line, and then it eventually broke out here, made a new high, and rolled over sharply. We're seeing almost the exact same pattern here. It's stretched out. It's taking a little longer to materialize, but we're seeing a trend line with higher highs. We broke out on the Ukraine war. Had we not had a war between Russia and Ukraine, we probably wouldn't have broken above $90 in oil here. We probably would have stayed here and just traded lower, which had been the norm for the last decade or so. Because we did break above that, this line now becomes support. I'm going to show you a strategy in a few slides to take advantage of the upside here, assuming this support holds, which I think it will the first time down. But eventually we are going to break back down into this area. The war's not going to last forever. The sanctions may or may not last forever, but the reality is Russian oil is coming onto the market. So at some point, prices will break down into their more normal, natural state. So one thing that a lot of people fail to recognize when they're trying to speculate in oil or commodities is these markets have natural cycles that they go on each year. There's an annual cycle, times of the year where the market has a tendency to be low and times of the year that it has a tendency to be high. In the case of oil, we generally see lows in the late spring, so late March, early April. We generally see highs in the fall, and that could be October, November. Seasonals aren't perfect. It's not something that you want to assume is always going to work out because it doesn't work out every year, but it works out most years. So you don't want to ignore them, but you also don't want to only trade on seasonals. You probably want to use seasonals as a tool to confirm any signal you may get on the chart and other analysis methods. Another thing to be aware of is the COT report. I briefly mentioned it a few minutes ago. It's the Commitment of Traders report. It's issued every week, every Friday specifically, by the CFTC, which is the Commodity Trading Futures Commission. It's a government agency, and they basically compile data on who's participating in the futures markets. They split it into three categories: speculators, large speculators, and hedgers. So speculators or small speculators are most of us. Large speculators are those that are trading very large numbers of contracts at a time. And then the hedgers are those that are participating in the market not to make money with their buys and sells, but to just hedge their price risk in the cash market. This is an important piece of information because it tells us who's long and who's short and to what degree. What I like to use the COT report for is to determine whether people are too long or too short. Is a trade overcrowded or is it not? This is just a small snapshot, by the way, but there's been a few times, for example, in 2008 and 2014, where speculators were getting a little long in the tooth and they were probably complacent. Speculators were longer than they would normally be, and volatility was on the light side, so they probably were complacent. And when you see that everybody's long, or in other words, everybody's bullish and everybody that wants to buy has already bought, a lot of times we just run out of buyers, and sometimes you can get some really big sell-offs because those traders, the only way for them to get out of the market is to sell their position and get out. So at some point, if everybody's long, they're eventually going to have to get out of the market, and if they do it all at the same time, it can put a really big damper on prices. Obviously, the same goes with the other way. If everybody's short, eventually they're going to have to get out. In crude oil, you generally don't see speculators net short. They're either really, really long or only kind of long. If they're kind of long, that's almost like being short. Each market's different, and unfortunately, the COT report's something you'd have to monitor for a little while before you get a hang of how to use it and how it might be helpful. As a general rule of thumb, commodities trade sideways. They're not like stocks that pay dividends or have, there's no share buybacks or anything to keep the prices continually moving higher. So instead, they almost always trade sideways. Sometimes those rallies can be magnificent and they can be, just unbelievably sharp, parabolic even. But that doesn't mean that they are sustainable. Commodity rallies are very rarely sustainable. In fact, they never are. This is a chart dating back to the 70s, and you can see that there has been some really big commodity rallies. By the way, this is the Goldman Sachs index. So this is not just oil. This is an index of, I believe it's 24 commodities. And you can see there's some really big rallies, but they're followed by collapses. And that's generally what you see in commodities. So you never want to be a complacent bull. You always want to know that if prices are really high, what happens is producers produce more and users use less. It's really that simple. So you've probably heard the saying, the cure to high prices is high prices in commodities, and that's exactly what you're seeing on this chart. A lot of traders are tempted to participate in the commodity markets via ETFs. And the reason is that they're very convenient. Most people have stock accounts already open. They have access to ETFs. It seems like a very easy, quick, and convenient way to get access to commodities. But the reality is those ETFs are very inefficient. If you're going to speculate in commodities, and I'm not saying everyone should, but if you're going to, A better way to do it is in the futures market. Now, you've probably heard of all the horror stories of people losing money in futures and so on and so forth. And I understand that, but there is a way to participate in the futures markets without the over leverage or massive leverage, and I'm going to talk about those today. The reason futures are so efficient is crude oil futures are basically tradable contracts that represent delivery of the physical oil at expiration. Now, you or I would never be able to make or take delivery of oil just because we don't have the licensing or the storage capacity and so on and so forth. But if you really wanted to, if you had all of those things and you were capable of taking delivery of oil, you could. And that's what makes the futures contract so efficient is at the end of it, it's an agreement to buy or sell the underlying physical asset. If you're trading an ETF, you're trading something that is created to mimic the price of that asset. And a lot of times it doesn't follow. A lot of times crude might be up 5%, your ETF might be up 1% or vice versa. It's just really inefficient. On a side note, in March of 2020, April of 2020, when oil went negative, part of that, in fact, actually a big part of that was a blow up of a crude oil ETF. And it was as people are throwing money in and out of these ETFs, sometimes the commodity market underneath it just simply cannot handle the inflow and outflow of cash, and it creates a massive amount of volatility. So not only are ETFs inefficient, but in many ways they're actually interfering with the ability of futures markets price discovery. Futures are traded around the clock. Crude oil futures trade 23 hours a day from Sunday night through Friday afternoon. They are more tax efficient than trading an ETF. You, as a futures trader, assuming you make money, you get a 40-60 blend between long-term and short-term capital gains. And the nice thing is, there are multiple contract sizes to trade crude oil. There's a mini, a micro, and a full size, and we're going to talk about that soon. The average speculator is best off sticking to liquidity. So I suggest focusing on crude oil and even natural gas. There are full-sized mini contracts and micro contracts, as I just mentioned, and there's liquid option markets for those. Avoid the distillates, heating oil and gasoline. Unless you're trading a large account and you're experienced and you know exactly what you're getting yourself into, stay away from those markets. Thankfully, the CME Group listed smaller crude oil contracts to open the door to retail traders of really almost any size and risk tolerance to participating in crude oil. The original full-size crude oil futures contract represents 1,000 barrels of oil. This means for every tick or every penny that crude oil moves, a trader makes or loses $10. If you're doing the math, for every dollar that oil goes up or down, that means the trader is making or losing $1,000. Now, when oil is behaving itself, believe it or not, crude oil has been the most comfortable between $50 and $75 since fracking became mainstream. So when crude oil is hovering in the $50 to $75 area, it's generally moving $1 a day, maybe $2 a day. A $3 day is a big day. In 2022, or specifically since the invasion of Ukraine, crude oil has been moving several dollars a day. We've seen some $14, $15 days. That's $15,000 per contract on the full size. As you can imagine, that's a lot for many traders to handle, and just too much, too big, too much leverage, too much money being made or lost in a short amount of time. So there are smaller contracts that make it a lot easier for traders to handle. There's a mini crude oil, which is half the size of the original contract, or 500 barrels. And then there's a micro crude oil, which is relatively new. It was listed in 2021, and it's great. With a micro contract, it's 1/10 the size of the regular contract. So if oil moves up or down $1, a trader makes or loses $100, not $1,000. It's only $100. So even if we have a wild, silly, volatile day in which crude goes up or down $10, a micro contract is only making or losing $1,000, which again is still a lot of money, but it's nothing compared to the $10,000 you would make or lose on a full-size contract. Now keep in mind, as a futures trader, you pick your leverage. Most people assume that you have to just trade on leverage and you're at the mercy of leverage, because as we know, if you're trading on leverage, you can make or lose a lot of money in a short amount of time, because what you put in your trading account is controlling a much bigger contract. For example, if we look at the full-size crude oil contract, the margin is, we're just going to round to 10,000. The margin on a full-size contract is 10,000. The current price of crude oil is roughly $100 a barrel. Again, I'm rounding, but you get the idea. So you're trading $100,000 worth of oil for $10,000. So if you fund your account with $10,000 and you buy one futures contract in oil or sell, whatever you do, that $10,000 is just your good faith deposit on how much you make or lose on the position that is going to make or lose money based on $100,000 worth of oil. You can see how people get into trouble with all that leverage. But as a trader, you don't have to use that leverage. You can take leverage out of the market by by overfunding your account. This means if you have a $100,000 account and you buy or sell one crude oil future, you have zero leverage. It's a pure speculation with no leverage. Of course, not everybody has $100,000 to put in an account to buy or sell one crude oil future. But if you go with the micro, you're representing 100 barrels, not 1,000 barrels. So instead of trading $100,000 worth of oil, you're trading $10,000 worth of oil. And if you put $10,000 in an account and buy or sell one micro, you have zero leverage. So again, it's your choice as a trader to use leverage or to not use leverage. The less leverage you use, the more room for error you have, and it makes it more of an investment than a trade. That said, I already pointed out to you that commodities don't go up over time like other assets do. So even if you are looking to buy and hold crude oil because you think it's going higher and you take all the leverage out by over leveraging your account, don't think that you are long-term investing because you're not. Any participation in any commodity is a trade. It shouldn't be a long-term investment because, as we already pointed out, crude oil can go up for months or years, but it never goes up for decades. So just be very careful about being complacently long or short or whatever it is you're doing. There are crude oil options on the full-size contract, and the exchange is just in the process of listing micro crude oil options. So that's going to be an excellent product. The reason I have a question mark in the margin column is options are complicated. If you're buying options outright, just buying calls or buying puts, there is no margin, but you have to have the money, of course, in your account to purchase any option you want to buy. If you're trading spreads, it gets really complicated. Margin on option spreads or short options changes with volatility and time. It's not a static amount like it is in the futures market. It's not something we're going to get into today, but we will show you some option examples. Just to kind of give you an idea of the difference between the contract sizes, this is a move from December when oil was in the mid to low 60s to just recently, a couple of months ago, I think this is before the Russian invasion of Ukraine. So this is just a little snapshot of before all the chaos that ensued after that event. But you can see that with a micro contract, a trader that happened to be lucky enough to buy the low and sell the high would have made about $3,000. Of course, if you sold the low and bought the high, you would have lost $3,000. A mini trader would have made or lost $14,500. A full-size trader would have made or lost $29,000. So this is just to give you an idea of how much of a difference the contract size makes. And to also point out that if you're trading a micro, you can treat it a little more as an investment. Your timing doesn't have to be perfect. You can buy it, and if you're $5 early or $5 late, it's not going to be the end of the world. If you're trading a big contract or a regular contract, being $5 early or late is a big deal because it's a lot of money. So because the micro futures contract is so small, traders that normally wouldn't have access to certain strategies can now access those strategies. For example, scale trading. Scale trading used to be something that was only reserved for people that had really big accounts because it took a big account to scale trade a market like crude oil. But with the micro futures, the margin's low. Even if you're not trading with leverage, you can have a reasonable account size and still scale trade oil without hopefully doing too much harm unless you get just caught in a perfect storm of chaos. I also want to point out that the micro contracts are smaller, but they have the same amount of leverage. They have the same 23-hour market access, including Sunday evening, and they're liquid. They also have the same tax benefits that the big futures contract has. And again, as a reminder, they're more efficient than commodity ETFs. So if you truly want to speculate in oil, the price of oil, the most efficient way to do it is through the futures contracts, and specifically micro futures if you're going to do it in a smaller way. The micro version of crude oil has really mitigated a lot of obstacles for traders. For one, there's a lot less margin concern. The margin on a micro contract is less than $1,000 usually. Now, it can fluctuate with volatility, but it's probably not going to get a whole lot higher than $1,000, at least not in the foreseeable future. This allows traders, even with small accounts, to hold overnight positions without losing sleep. And even more importantly, they're not forced out before the close when trading in small accounts. A trader that has a $5,000 account cannot hold a big futures contract or a full-size futures contract into the close because it triggers a margin call. Even a mini contract would probably get really close to triggering a margin call or at least being uncomfortable. A micro contract can be held into the close in a $5,000 account without really any concerns of margin. So keep in mind, if a trader has let's say a day trader gets a buy signal prior to the close, maybe even 2 or 3 hours before the close, and he takes it, if he's trading a full-size contract, regardless of whether he's reached his profit target or his stop loss order, he has to exit that day trade because he's out of time. And obviously, if a trader is not able to allow his trading strategy to work, there's a pretty good chance that even if the strategy is good, the trades aren't going to work. The micro contracts offer lasting power. Traders are less prone to panic, and they may even be comfortable not using a stop loss. I know most people assume that you need a stop loss to protect yourself, and I'd say that's probably true in many cases, but the reality is if your stop is too tight or if you're trading with aggressive stops, your odds of getting stopped out are very good, and a lot of times traders get stopped out right before the market goes the intended direction, so it can be very frustrating. So with a micro contract or a smaller contract, you're allowed to, or you're given a little more comfort when it comes to riding the waves, and you're more likely to stay with the trade and have a chance to recover if it doesn't go your way immediately. There's also more room for error, and in my opinion, because of this, better odds of success. You can trade comfortably with plenty of excess margin. You're probably going to see a lot less account volatility. Even mini oil is not as many as the name implies. I mean, again, we talked about oil has been moving $8 to $10 a day. Not every day, but we've seen quite a few of those types of days recently. So even a mini contract and a $10 day in oil is a $5,000 profit or loss for a trader. That's a lot for a quote unquote mini contract. So the micros on a $10 day, a trader would make or lose $1,000. That is a lot more easy to manage than the mini or the full-size contract. And trading is an emotional game. If you're trading a smaller contract, the emotional turmoil is going to be mitigated. So the micro futures are going to cause less stress and hopefully lead to better trading decisions. For those that want to trade with bigger size, the micros can be used as kind of a way to paper trade with some skin in the game. So you can use micros to test new strategies or just simply get familiar with commodity trading if you're used to trading stocks. One of the biggest advantages of the micros is speculating with longer time horizons. Because of the large contract size of the regular futures contract, traders are usually speculating with time frames of a couple of days or a couple of weeks. But with the micro, you might actually be comfortable enough to buy and hold for months, or at least with an intention of doing so. And again, it's because the contract is smaller, the fluctuations are going to be smaller, the profits and losses are going to be smaller, it's just more comfortable. The small contract size of the micro allows traders to be a little more aggressive when it comes to swing trading. Swing trading is basically buying the dips and selling the rips, but with reasonable risk. If you're a bit full-size futures trader and you're trying to buy a $10 dip in crude oil, that's really scary because if you're $2 early, you lost $2,000 in a couple of seconds. That's how fast it moves. If you are $2 early on a micro, you're going to be out a couple $100, but you're going to be a lot more comfortable in trading those aggressive price swings. Also, with a micro contract, you can scale in and out of positions incrementally to improve your average entry price. So for example, if you go long a full-size futures contract, which is 1,000 barrels of oil at, let's say, $90, you're long from 90 with 1,000 barrels, and you hope that it doesn't really go too far against you because it's going to be pretty painful. But with the micro, maybe you buy one contract at $90, maybe you buy another one at 89, another one at 88. If it never goes to those prices, then it's not the end of the world, right? Maybe you pick the low and you're yet a successful trade on one single micro. That's not the end of the world. But if it does go a little bit lower and you still think oil is going up and this is a buy the dip opportunity, if you're adding incrementally, your average entry price might be somewhere around 87 or 88 after you get them all on, as opposed to a $90 entry price if you just went long the full futures contract. So it's a way of dollar cost averaging. So this is a visual example of what I was just talking about. If you were somebody that wanted to position trade. If you had a long-term outlook in oil and you were bullish from the low 70s in late November, early December, you're bullish from the 70s. You're not sure that your timing is exactly right, but you know at some point in the future you'll be profitable. If you bought a full-size contract there based on what unfolded here in the next couple of weeks, you could very easily be out $10,000 to $12,000 in a matter of a couple of days. But if you went with the micros, you could start buying at 73. You can add on after the big downfall. That was like the day of or the day after Thanksgiving, I believe. And oil was down $8, $9 in a single day. So you could buy one at 73, you could buy another one at 66, buy another one at 62. And at this point, the maximum drawdown with all of that going on is only $1,500. If you were trading a full-size contract, your drawdown would have been closer to $15,000. So as you can see, $1,500 drawdown, I mean, it's not ideal, and you would hope that oil wouldn't drop $10 in a single day after you bought it. But if it did, and your horizon is the long run, not the next couple of weeks, the micros are a lot more forgiving. So let's talk about risk reversals. Now, this is a strategy that is considered very aggressive. Risk reversals are probably best used as portfolio hedges, but that's a whole nother topic. Today, we're going to talk about speculating in oil with risk reversals. Now, if you're not familiar with risk reversals, it's basically the idea of selling a call option above the market and using the proceeds to buy a put option. Assuming the market doesn't explode dramatically higher against you, you make money either through the premium that you collected, or if the best case scenario unfolds and the market rolls over sharply, you make money on the premium collection in addition to being long a put option. So let's take a look at a specific example. This was a couple of months ago, this was possible, but the volatility was high. And so this was probably a really exceptional opportunity that doesn't normally present itself, but this just gives you an idea of how the strategy might work in a best case scenario. So it would have been possible to sell an August 140 call for $5 in premium. This is a full-size contract, so each dollar in premium is $1,000. So that's $5,000 that the trader would be collecting. At the same time, that trader could purchase an August 85 put for $3 or $3,000. The net credit is $2,000. So the market is not only paying you to put on the trade, but it's also paying for your put option to give you downside exposure. The margin on this trade at the time was $4,600. The risk is unlimited above 140 at expiration, and the profit potential at expiration is theoretically unlimited below 85. Let's take a look at a chart just to get an idea of how this might look. Now again, this was during the heyday of volatility in crude oil in early March. These types of opportunities with this pricing, they're only going to come up once every several years, maybe even once a decade or less. So this isn't something you should expect to see all the time. In a more normal market, you maybe could have sold like a 120 call and bought a 90 put for something, similar premium. Again, this is just an educational example. If volatility is high, risk reversals offer a very attractive opportunity because you can get aggressive and you can have plenty of room for error. You can see at the time of this trade, the oil had peaked out around $110 a barrel and it was now trading around 90. So in order for that 140 call to get into a whole lot of trouble at expiration, oil would have had to have rallied about $50 from where it was. Now, at the time, to be honest, that didn't seem that impossible. There were a lot of people out there calling for $150 oil. People were expecting oil to retest the 2008 highs. And so this wasn't as obvious then as it seems today, but nevertheless, it still seemed like a pretty good idea. So a bearish oil trader could look to do something like this, basically take the market's money to purchase a put option as opposed to spending his own money, and also bring in a little extra premium on the side. This is why when you're trading options, it's really important to pay attention to volatility. If you're trading short options or you have short option risk, in this case, this trader has unlimited upside risk. If you are taking that risk in a quiet market, most of the time you're going to get away with it. But occasionally, like in March of 2022, that's going to come back to bite you. And unfortunately, I've been there and done that and learned those lessons the hard way. But you can see risk reversals can offer a really attractive way to play the market without getting into too much trouble unless you're just completely dead wrong. Now I'm going to show you an example of something we presented to our clients just recently. This is the DeCarly Perspective. This is a newsletter that we send out to our clients if we see a trading opportunity. Again, we don't have a crystal ball. We are not perfect. Sometimes we're wrong. But the idea is we want to help people think about markets in a different way than maybe they've thought about them before and look at different opportunities. So this is just again for educational purposes, but this is an idea that if you recall earlier in the presentation, I showed you a monthly chart of crude oil. And I showed you that on a monthly chart, we have in March, we broke up against, well, we tested and then eventually broke out against the monthly trend line. And we've actually now dropped back down to that trend line, which is now going to be supportive. And if you draw the same or a similar trend line on a daily chart, it comes out to around the same place. So somewhere in the $90 area for oil is the make or break area. Either it holds here and we rally back up at least temporarily, or we completely melt down and we're going back into the comfort zone between $50 and $75. I personally think that we probably get a little bit of a rally first. Now, I think that we've probably seen the highs for oil for this move earlier this year, but that doesn't mean we can't go up and retest 110, 115, maybe even almost 120. So those types of things are possible. So for those traders looking to play the upside, this is one way to do it without having immediate, well, let's just say without having to be perfect. You can have some room for error. So the idea of this trade, and by the way, this is called a bull call spread with a naked leg, and that's because the trade would be buying a call option. That's the money maker. The idea is to make money on this 90 call and then sell options around it, in this case the 100 put and the 77 put, to pay for the speculation. If we just bought the 90 call outright, it would cost us about about 7,600. That's a lot of money for an eroding asset that may or may not expire worthless. So instead of spending $7,500 on the 90 call, we can sell the 100 call and then also sell a 77 put. And that brings our net cost down to 43 cents roughly, so about $400 in oil. So if the market is between 77 and 90 at expiration, we only lose about $400 on that trade. If the market is above 90 but below 100, we make something. If the market's above 100, the trade maxes out, and the profit would be somewhere around 9,600 before considering transaction costs. So that gives you an idea. Now the risk on this trade is below 77. If the market starts dropping below 90 and support fails, it could get pretty ugly, and 77 is not out of the question. I know most people think that's impossible, but nothing is impossible in oil. Trust me, I've seen it all. Below 77, this trade has unlimited risk. It's almost like being long a futures contract from 77 if it gets down there. So let's go down to the trade stats here. These options expire on September 15th, about 63 days. So there's plenty of time for the market to prove us right or wrong. The margin on a trade like this is 5,500. The risk, like I mentioned, is unlimited below 77. The profit potential is about 9,600, and that only occurs if you hold it all the way to expiration, which isn't likely, and I'll tell you why in a minute. But if you did hold it all the way to expiration and oil was above 100, you would keep $9,600 minus your transaction costs. It's very rare for traders to hold the expiration, and to be honest, they normally shouldn't. And the reason being, even if we're right about this and oil bounces and moves higher, there's a very good chance that sometime between now and 63 days from now, that initial rally rolls over and goes the other way. So it's just a matter of not being greedy. If you put a trade like this on, the market goes your way, the first thing you want to do is buy back your short put, because this is where all of your risk is. If you buy back that put and take a profit, and then the market melts down from there, then it's still a bummer, but it's not going to be too painful. So this is your first step, is buying back the 77 put. But if the market goes your way initially, let's say that a trade like this is put on and the market rallies 10 to 50, let's say the market rallies $10, and that trader can take a quick profit of 2, 3, 4,000, I absolutely believe that trader should take it. Even though the max profit at expiration is almost 10,000, it's just not worth holding the risk. In other words, if you can make 3 or 4,000 in a week, but you have to hold the trade for 8 weeks to get the rest of the money, a lot can happen in 8 weeks. I mean, we've seen, if you look at this chart, we've seen just in a couple of days, we've seen oil drop $30, $40. So anything can happen. Don't be greedy with these types of strategies. If the market gives you a gift, take it. What you could do if you put on a trade like this and it did go your way and you could pull some money out of the market, you could put on a very similar trade or maybe a trade that has less downside risk at higher prices. So maybe if this trade went your way, you could get out of this, take your money, and then maybe buy like a 100, 110 call and just leave it like that. Don't even sell a naked put. Because the higher oil goes, the further it eventually will fall when things do crack down. Remember I showed you that chart earlier? Commodities always seem like they're going to go up forever, but they don't. I'd like to offer a couple quick notes on option trading. This class is on crude oil trading, but for those that do decide to venture into the option side of things, instead of using micro futures or mini futures or whatever it is they're looking to do, option trading is often overlooked because it's a little more complicated than trading futures, but there are some really glaring advantages. The advantages are more room for error. You can avoid premature stop outs. For example, in the risk reversal example or the bull call spread with a naked leg example we went over, you don't have to worry about being stopped out. Now you have to worry about the market going against you and things getting painful and you having to hedge. By the way, hedging might mean buying or selling futures, mini futures, micro futures, or even full size futures against your options to mitigate risk. So it can get pretty complicated. If you want to learn more about all those types of things, you can read that in my book, Trading Commodity Options with Creativity. But the thing to take away is you don't have to worry about stop outs. Using stops is one of the primary risk management tools for futures traders, but the problem is sometimes it increases the risk because it stops people out before the market moves in their intended direction, and then they start emotional trading or revenge trading. So it's not as easy or as clear cut as it might seem. Also, options can mitigate some of the emotional turmoil because while a market can obviously go against you and you can be wrong, the way that it mitigates emotional turmoil is there's not necessarily immediate risk like there is futures. If you buy or sell a futures, you're immediately making or losing money with every tick that the market moves. In options, you're immediately making or losing money, but it's not the same. For example, in that example we just looked at where our risk is below 77, if crude oil is at 91 and it drops to 90, you're probably not going to be stressed out with your option spread because you know as long as it doesn't go towards 77, you might be okay. But if you're trading a futures contract and you buy at 91 and it goes to 90, that's going to be a little bit stressful. So it just changes the game from an emotional standpoint. Also, with option trading, there's more than one way to make money. You can make money on time value erosion, and you can also make money on direction. So that risk reversal trade or strategy that we talked about, if the market goes sideways and it doesn't sell off like you think it might, you still make money on the premium erosion, assuming the price doesn't go above 140. If you're right in the direction, that's just a bonus. One thing I like to point out with options is be cheap. Options are priced to lose. Thus, if you're simply buying options outright or buying vertical spreads, it's a relatively low probability venture, so you better have perfect timing. In my opinion, option traders should strive to be cheap, and this means using the market's money to finance positions or hedge speculations. That's not something that always works exactly as planned. If volatility explodes and you're in the wrong place at the wrong time, it can get pretty scary. There are ways to hedge those positions or hedge short options, and I talk about that in the books. And just like you would with futures contracts, with options, you're ideally looking to buy the dips and sell the rips. And what this means is you're not going to want to put a risk reversal on like the way we showed you if the market was cheap. So for example, if crude oil sold off from, let's say, $100 a barrel to $50 a barrel, that's not the time to sell a call and buy a put. It's probably the time to do the opposite. Maybe sell a put and buy a call. So risk reversals or bull call spreads with naked legs, they should only be done when you think the market's going to turn the other way, not after the trend is maturing. In conclusion, they don't call it crude for nothing. Crude oil futures are efficiently priced and convenient to trade around the clock with liquidity, but they are volatile. Sometimes they're just downright not fun. Trading beneath one's means helps reduce feelings of panic, and this can be done with either micro futures, option spreads, or both, especially now that the micro futures have options written against them. Now, keep in mind, not all brokerage firms are going to offer those products, and some brokerage firms are slow to get them on their platforms. Thinking outside of the box enables traders to manage risk while sticking with their original speculation. So even if you go with option spreads, let's say you want to participate in a risk reversal or some sort of option spread, you can use micro futures to hedge if things go wrong. So keep in mind, you don't have to only trade futures or only trade options. You can use both of them interchangeably to create the risk and reward profile that you would like to create. Thank you for your support. I hope you learned something from this class. If you have any questions or comments or concerns, please get a hold of us. I'll show you my contact information in a minute. But in the meantime, if you want to learn more about trading futures and options or our brokerage services, please visit DeCarlyTrading.com. And if you're interested in reading any of our books, they're on Amazon, but you can also visit TradingCommodityOptions.com for excerpts and samples. And this is my contact information. I'd love to hear from you. If there's anything that we can do for you, let us know. Thank you.